Assalamu alaikum. Okay, today's lecture number 12 for this course, and this is the second last class. Then it will be finished, inshallah, after 13. That is going to be the task class. Today is only one thing which we need to do because that is based on the task 4, your 3.2 assessment criteria. It says use costing techniques for pricing purposes. Here, there is no specific command verb, and honestly, in the task 4, we do not even want to work on any of the command verbs. We will only follow the numbers and just simply put everything in the formula. And it's very easy as compared to task 3. Costing techniques. Now, what are these? Costing techniques are the methods used by the businesses to determine the total cost of producing a product or providing a service. The complete cost from the execution of the project plan till the end it receives to the end user, whatever the cost is, you are going to put that under this category. Now, there are different techniques, tools through which we calculate the cost. To find out how much it costs to make a product, let's say a cake, to make a cake or a brownie, we need to first purchase a flour, then the utensils, chocolate, then we have the variants of it as well, the quality variants, vanilla essence, egg, and I mean, so many things to put in it. What are all these? These are the cost. And then once you incur the cost, then you put the profit margin. To deliver a service, including all the materials, labor, and overheads, that is the expenses as well. Packaging, branding, supply chain, everything will be in this. Now, what are the pricing purposes? This is the objectives, which refer to the reasons or goals a business sets the prices for its products or services. Now, a normal chocolate, it is not expensive at all because we are directly getting it from the cocoa. But when we are suppressing it, reducing it into different variants, quality, flavors, and standards, the price changes automatically and the flavor too. To decide the selling price, that is at what price the product is going to be sold out in the market, that helps achieve business goals such as the profit, material share, or the survival. Now, it depends on the company whether they want to charge very high price or just a normal price, which is acceptable by every human. Costing techniques determine the minimum cost of a product. This is just a summary that what these two terminologies mean. It's just a simple cost, and the pricing purposes decide how much extra, that is the profit margin, to add based on strategy and market conditions. Because according to the environment of the market, industry demand, we are going to set the prices. If the product is quite common, like a quite viral one, we can charge higher prices too. But if it's something unique and you are going to launch it for the very first time in your area, in your city, or in your sector, then you can charge high prices as well. Okay. For example, if the total cost, that is from the costing technique, remember total cost is created when we amalgamate both the fixed cost and the variable cost. Fixed cost does not change and the variable cost, it constantly changes. It is $50. Now the company wants 20% profit. It's just a cost, and the profit which they're expecting and they are demanding by the producers that it must be 20%. Now, what will be the scenario? Then the selling price would be $50 plus into bracket 20% of $50, which equals to $60. So in total, you're going to charge 60 to the consumer so that you can regain 20% at the end. Now, according to your indicative content, the first point was classifying cost. First is cost can be broadly classified into direct, indirect, fixed, and variable cost. Direct costs are the ones which are expenses directly attributable to producing a product or providing a service. For example, it includes raw materials, the data which we need, the material which we need to make the product. Direct labor, the people we are hiring. In manufacturing supplies, all the machineries, boxes, everything. For instance, in a car manufacturing company, the total cost, the cost of the steel used to build the car would be direct cost because that is what is a mandatory raw material is. Without the steel, you cannot build the car. So it is a direct cost. You cannot omit it. Indirect cost, however, is that they are not directly tied to a specific product or service, but are necessary for overall operation, just to have the guarantee that the operations are running smoothly, the daily working capital is going nicely. We need to cover it up, like administrative salaries, rent, and utilities. For example, the electricity used to highlight a manufacturing plant would be an indirect cost. I said, is the example clear that the electricity used to light a manufacturing plant, any factory, would be an indirect cost, which is not directly affecting, but we do need it so that operations are running smoothly. Without the light, what will happen? 1 day, 2 day, it will be out of supply, the electricity, the work is going to be stopped. But the next day, the third day, fourth day, and the continuous days, we have to fix this problem. You cannot ignore it. So not directly, but indirectly, it affects the working of the business. Fixed cost, which is not changing, these costs remain constant regardless of the production volume, such as rent or salaries of permanent staff. Now, the people you have hired in the organizations and they are on the permanent designation, no matter what, if the profit or the sales are going up or down, you need to pay them. It won't hinder their salaries or anything, that is fixed. For example, it would be the salary of a factory supervisor. No matter what, we need to pay them. However, the variable cost, these are the changing cost with the level of production, such as the cost of raw materials. Obviously, when I'm going to get the order of 1,000 cakes, rather than usually I used to get 500, my cost of material is double now. Everything is changing. So that is how variable cost changes. For instance, if a bakery makes 100 cakes, the cost of the ingredients will vary based on the number of cakes produced. Maybe 100, maybe 120. Even for 101 cake, the cost is going to be different. Now, number 2 was calculating the unit cost. What is a unit cost? This is the total production cost divided by the number of units produced. First of all, what is production? The goods and commodities we are producing in the warehouse and the factories, they are known as the production of the goods and commodities. And then we divide it by the units produced. Let's say 50, 100, and so on. That is how you calculate the unit cost. It indicates and includes both direct and indirect costs. So you amalgamate both of the cost first, and then you add that in the production cost. To determine the price of a product, that is to exactly know what price we are going to label up the product, businesses often begin by calculating the unit cost. For example, let's say a company produces 1,000 units of a product with a total cost of $50,000 itself. Total direct cost is $30,000, which means including materials, labor, everything. What is this? Directly affecting the production. Indirect cost is 20,000, which is overhead, utilities, etc. By amalgamating, adding up, we get $50,000 in total. That is what the total cost is. So how we are going to get the unit cost? Total cost divided by the number of units. Total cost was what? 50,000 divided by the unit produced, 1,000. So every commodity, every product which we are producing, it will cost $50 per unit. Then number third heading was dealing with the overheads in manufacturing and service industries. Overheads are the daily expenses. Manufacturing is the one where we are producing the products, we're making it, and service industries where we are providing the services. Overheads are indirect costs that cannot be directly traced to a specific product because you cannot literally calculate that what will be the expense today and tomorrow. It can vary. Business use different costing methods to allocate overhead costs to products or services. The first type of costing is the full absorption costing. What it means, this method involves allocating all the fixed and variable manufacturing overhead cost to each unit of production. Let's say I'm producing 100 units. For every unit, that is 1, 2, 3, and so on, I can calculate the absorption costing. It ensures that each product is priced to cover all the costs, not just the direct cost. That is fixed cost, variable cost, indirect cost as well. Okay, for example, a company producing furniture would allocate the costs such as factory rent, utility bills, and depreciation. Depreciation is the useful life of an asset over a period of time. and it always depreciates, that is, reduces, of an equipment across all products manufactured in a specific period. You're going to calculate each and everything. How? When you're able to know how many units are being produced. Whereas activity-based costing, ABC, is it allocates overhead cost based on the activities that drive the cost. Those events, those things which create the cost, we are going to calculate that in the ABC. It is more precise than full absorption costing and is commonly used in service industries where we are providing different sort of services to the consumers, to the government, and so on. For example, if a consulting firm uses 3 hours of meeting time, the cost of meeting space and utilities can be traced more accurately to each client project based on how much time is spent. Obviously, it's very easy. That is why it is easy to tackle the activity-based costing. The time the room is going to be busy, you can allocate that. The chairs, the members, the forms which they fill, everything can be tracked out easily. Pricing strategies. Several pricing methods are commonly used based on the calculations of the cost. We have so many variants in the cost. Cost plus pricing. What is this? In this method, business calculate the cost of producing a product and a fixed profit margin on the top. First, what will be the cost incurred to make a pizza and what amount of profit I'll be having it after deducting all the expenses and the amount. For example, if a unit cost is $50 and the business wants 20% profit margin, the selling price would be, the formula is, which you're going to use in task 4.2, unit cost plus bracket, unit cost multiplied by profit margin into bracket. So in total, the pizza price is going to be $60 each. Marginal cost pricing. Now this is the one which is set based on the marginal cost of producing an additional unit. Daily purposes, on the daily basis, I am making 100 units, but today I got the order for 120 cakes. So what it will be? A marginal cost, an extra cost in producing each unit. This method is useful when a company needs to temporarily increase market share or deal with excess capacity. Mostly what happens, we have so many raw materials left at the bakehouse and it can literally get dumped. So what happens? We put sale, and in, I think, which brand, there's a famous brand of the donuts which make their prices half in the evening rather than in the morning. I just forgot that. So this happens. Like, these are all the reality-based things. For example, if a factory fixed costs are covered and producing one more unit cost for only $10, that is the variable cost which is changing, the company may decide to sell that extra unit at $12 just above the marginal cost to increase short-term sales. Because it happens. Sometimes, like in the corona, we were all searching for the sanitizers and the face masks, and the prices were at skyrocket. They were very expensive. The reason was people and the producers knew the normal people, the humans, as in the consumers, they're gonna buy it no matter what the price is going to be. So we can charge more. Price takers, however, are the one which takes the price. You cannot argue with them. Businesses operating in competitive markets may be price takers rather than the price makers. Monopoly, oligopoly, the one which are selling something unique, the electricity suppliers, the water suppliers, they always go for the price maker strategies. They make the price by themselves and we are bound to buy it, the life-saving drugs as well. Whereas the price takers, you cannot increase the price. The prices of the tomatoes, the bread, the margarine, the chocolate, it remains the same, only the variance changes. If you think that one shop is selling quite expensive, you can definitely shift to another one. These companies do not have much control over their pricing because the market sets the price. For example, agricultural products like wheat are often sold at market prices. Yes, there are a few countries which sell the wheat and the sugar at higher prices, but the reason is recently, as we did face the flood problem, the crop got destroyed. That is why they increased the prices. So leaving a little room for the individual pricing strategies, and that is why we cannot even argue much. Number 5th point from your indicative content is break-even analysis. Now, this is used to determine the point at which the total cost equals to total revenue. Total cost is the fixed cost and the variable cost. Revenue is the complete sales plus revenue. It helps the businesses understand the minimum sales volume required to avoid losses. That is, it is mandatory to reach this point of sale so that we do not overpower the problem of loss. That is the net loss. So the formula of the break-even point in unit is fixed cost divided by bracket selling price per unit less variable cost per unit. So first, you are going to calculate the denominator part, that is the below one, selling price per unit and variable cost, and then the numerator fixed cost. For example, if a company has fixed cost of $10,000, a selling price of $50, and variable cost of $30 per unit, the break-even point would be very simple. First, solve 50 less, what's the other point? 50 less 30, you will get obviously 20. So in overall, you're going to divide 10,000, that is your fixed cost, divided by 500 units. The company needs to sell at least 500 units to cover all the costs, that is all the cost which was incurred while making that commodity. Marginal costing. Now this focuses on the variable cost of production, ignoring the fixed cost in the short term, only for the shorter period of time. But in the longer period of time, we do consider it. This method is especially useful when businesses need to make pricing decisions based on changes in production levels. In summers, the production of iced coffees, ice cream, it literally surpasses. But in the winter, things are different. We are into more hot chocolate and coffees rather than the cold beverages. We often like to have the ice creams, but not every day. For instance, during a period of excess capacity, a hotel may decide to rent rooms at a price lower than the full cost, but higher than the marginal cost to generate short-term cash flow. Just for a shorter period of time, we do these things. It is very common. Then we have to do this question as a heading. Explain how marginal cost can be used to set discount prices. Now, how it helps to set up the discount prices, we will read this. Using marginal cost to set a discount price, marginal cost is the additional cost of producing one extra unit of a product. It only includes variable costs such as raw materials, direct labor, and packaging, not the fixed costs like rent or salaries. Explanation. When a business wants to offer a discount price that is less price than the actual price, especially during the off-peak seasons or to clear the excess stock, it can use marginal cost as a guide to ensure it does not sell below the level where losses increase. So we are not touching the ground of loss, but the actual cost which was used to reduce the product, the cost which was used to manufacture the product, we are going to only regain that. So no profit at all. If the discounted price covers at least the marginal cost, the business can still contribute something toward covering the fixed cost at least and making a profit even if small portion because you're not in the loss strategy. Just an example, descriptions and amount per unit, selling price 100, variable 60, fixed cost 30, total cost $90. Now the company faces low demand and wants to attract consumers with the discount just because they were not having nice demands at all. So if it offers a discount price of $70, what will be the scenario? Covers the marginal cost that was already $60, contributes $10 towards the fixed cost, and avoids the loss on the variable expenses that is on the most rapid seasons. Although profit per unit is lower, the firm is still better off selling at $70 rather than producing nothing, which would still incur fixed costs. So it's better to have at least small portion of profit rather than backing off. That's not an option at all. So marginal cost helps identify the lowest acceptable price for the discount offer. Selling above the marginal cost means the firm is at least covering its variable cost, that is the daily expenses. It is often used in short-term pricing decisions such as seasonal discounts, winter, summer sales are going on, the mid-season sales are going on, clearance sales just when you think the things are getting obsolete or they're not selling it out the way they used to. Competitive pricing, the one in which so many competitors are there in the industry, then you need to compete with them accordingly. Special bulk orders, when you go for economic order quantity or economies of scale, there we use this concept. If you make things in bulk quantity, you order in bulk quantity, you will get the discount and more stuff is going to be sold out too. Using these various costing methods for pricing helps businesses determine accurate and competitive prices while ensuring profitability. So the main aim remains again the same, that is, we do require profitability, profit at every stage, but you need to follow the proper propaganda for it. Whether through full absorption costing, activity-based costing, or cost plus pricing, the selection of an appropriate pricing strategy depends on the business model, industry, and market condition. Very true. Because we have so many variants in the businesses, whether it's a sole trader, partnership, private, public limited company. You cannot apply all types of strategies in every structure. You need to see which suits you the best and then you make it public. By analyzing the cost and applying the right technique, businesses can make informed decisions that support sustainable growth. And the ultimate legit thing is to work on the United Nations 17 SDGs goal. No matter what, it is mandatory, and this is the time actually to work on it. Then when you are going to work on the sustenance and the environment. Okay. For the real life example, I chose the Toyota Motors. Now this classifies the metal, tires, and assembly line labor as a direct variable cost, while the factory rent and management salaries are indirect fixed cost. This helps Toyota understand which costs change with the production and which remain constant, essential for budgeting and pricing vehicles. So when you have to give the original examples of real businesses, then the concept is a bit different. We have to use business terms. For the unit cost, we worked on the formula, and for the real life example, I chose Coca-Cola. So the formula sets the same, that is total production cost by the number of units produced. If the Coca-Cola factory incurs total cost of to produce 500,000 bottles, then unit cost equals to 1 million divided by the formula, and simply you're going to interface it like this. Then with dealing with the overheads, these examples I needed to do full absorption costing. For the Nestle, it includes raw materials, factory overheads, depreciation costs, and labor costs in product pricing for the items like Kit Kat bars. This ensures all costs are recovered in the selling price. Activity-based costing for the Samsung is going to be that it uses ABC to assign overheads like machine maintenance and quality checks based on production activities, which helps accurately the price complex electronics like smartphones. Then for the job costing, we can choose interior design company because mostly they take this costing method. A firm like IKEA Home Services estimates cost per client project materials, designer hours, and labor to quote a price unique to that specific project and a job as well. For the pricing technique, we did cost plus pricing, just to add up the formulas. Airline industry. Emirates Airline, this is for the marginal cost pricing, may offer discounted flight tickets. We do get on the off-peak hours, pricing them just above the marginal cost. Fuels, meals, and fuel wages, everything is going to be covered to cover the fixed costs like aircraft lease. That is it. They're not going to charge you any extra price. For the price takers, individual wheat farmers are the price takers selling their produce at the prevailing market rate and by the global commodity prices. That is overall in one country, let's say Pakistan, the wheat prices, I honestly don't know, maybe 400 per kg or 500 per kg. No idea, but generally this is the set price. For the break-even analysis and marginal costing, the example is simply, even in the question as well, things are given like this. You only need to add up with the formula. Just to recap, we did these costs, classifying costs, unit cost, overheads, pricing methods, break-even, and marginal costing. We did the techniques used as well. For the classifying cost, we did direct, indirect, fixed, variable. And for the overheads, absorption, ABC, job costing, marginal itself is a cost. Then these examples were used and purposes in the pricing. Then the overall example, which will picture skew the complete concept of the costing techniques. Coca-Cola uses various costing techniques to manage the production costs and set competitive prices for its beverages. You can go for the Pepsi as well, but it's just an example. Classifying cost. Coca-Cola separates the direct cost, that is ingredients like sugar, flavoring, and the bottles, and indirect cost, factory rent, machine maintenance. It also distinguishes the fixed costs such as salaries from the variable costs that rise with production volume. The moment like recently, back in 2 years, there was a sparkling decline in the sales of Coke due to the things going on. So what happened? Many other brands, they were introduced. They even set the prices lower. They added the different promotions. I mean, so many things just to make sure that people are buying it. Now, yesterday or day before yesterday, McDonald's is selling free cones to everyone in my city, Islamabad. Just you need to go there, vouch for it, and you're gonna get it. Because people are totally boycotting it. So these strategies are according to city, country to country, whether they are a multinational. It do affect. Calculating the unit cost, if the total production cost of 500,000 bottles is 1 million, the unit cost per bottle is $2. That is, the figure becomes the baseline for the pricing decision. Maximum, this is going to be the limit. Dealing with the overheads, using full absorption costing, Coca-Cola includes both fixed and variable manufacturing overheads, that is utilities, factory expenses, and product cost. For detailed control, it also applies activity-based costing to trace overheads like the quality testing or logistics to specific products as well. Different variants of the Coke. Pricing methods, Coca-Cola often applies cost plus pricing, which we did worked on, adding a profit margin to the unit cost. For example, $2 plus 25% equals to 2.50 is going to be the selling price. So what are they doing? Only 50 extra. In competitive market, it may use marginal cost pricing to offer discounts while ensuring variable costs are covered. When you need to compete with the Pepsi, break-even and marginal costing. This performs break-even analysis to determine how many bottles must be sold to cover the total cost, fixed and variable. It uses marginal costing for the short-term promotional pricing, ensuring each sale contributes to fixed cost and profit. And in that, even the promotional prices which we do get, they're not in the loss at all. They are still covering the fixed cost and the profit as well. So through this costing technique, Coca-Cola can control the expenses, accurately price its products, and maintain profitability even in a competitive global markets. So that is it for this lecture, which was the second last one for 3.2. Thank you so much, both of you. Take care of yourselves. Allah Hafiz.